Hey guys, in this video we'll analyze Tesla's latest 10K financial statements using the 5 core financial ratio categories every analyst should know: liquidity, leverage, efficiency, profitability, and market value. You'll learn how to calculate each ratio and interpret the results using Tesla's real numbers and understand what they reveal about the company's financial health. Here's what you'll learn: how to calculate the current, quick, and cash ratios for liquidity, how to assess Tesla's debt to equity and interest coverage ratios, how to measure efficiency, profitability, and market value with real examples, and how analysts use ratios to evaluate stock performance and company risk. So let's start with the most urgent question. Can your company actually pay its short-term bills? Liquidity ratios measure your ability to cover short-term obligations like rent, payroll, and supplier payments. If you mess this up, it doesn't matter how profitable you look on paper. So let's go ahead and look at the liquidity ratios for Tesla based on their latest 10K. So let's start with the most urgent question. Can your company actually pay its short-term bills? Liquidity ratios measure your ability to cover short-term obligations like rent, payroll, and supplier payments. If you mess this up, it doesn't matter how profitable you look on paper. So let's go ahead and look at the liquidity ratios for Tesla based on the latest 10K. All right, here's the formula. Our current ratio equals current assets divided by current liabilities. So now let's plug in our numbers from Tesla's 10K. Tesla has $58 billion in current assets and $28 billion in current liabilities, giving us a current ratio of 2.02. So what does that mean? A ratio above 1 means you have more assets than short-term debts, which is good. But if it's way too high, like above a 3, you might be hoarding cash instead of using it productively. Next, we have the quick ratio or acid test. This formula is current assets minus inventory divided by current liabilities. So why do we subtract inventory? Because you can't always sell inventory instantly for cash. This ratio tells you if you can meet obligations without relying on unsold stock. So using Tesla, we have $58 billion in current assets as mentioned above, $12 billion in inventory, and same as above, $28 billion in liability. Therefore, we have a quick ratio of 1.64. So if this dropped below 1, you might struggle to cover your debts if sales slow down. Analysts use this to gauge true short-term strength. Lastly, for liquidity, there is the cash ratio. And this formula is cash divided by current liabilities. This is the extreme test. Only cash counts. If your cash ratio is under 0.2, you might be one unexpected bill away from panic mode. Finance teams watch this one closely, especially in tight credit environments. Tesla, as of their 2024 10K, had $16 billion in cash and equivalents, and current liabilities stayed at $28 billion, giving a cash ratio of 0.57. So liquidity ratios show your survival skills. But what about your risk appetite? That's where leverage comes in, and this is where many companies just go off the rails. So moving on to leverage ratios, which tells us how much risk are you actually carrying. Leverage ratios measure how much debt your company is using and whether you can handle it. Too little, you might be growing too slow. Too much, and one bad quarter can wipe you out. So our first ratio will be debt to equity ratio, and this is total liabilities divided by shareholders' equity. If the ratio is 1, that means you're using equal parts debt and equity. If it's 2 or higher, lenders might start sweating a little bit. Tesla's total liabilities per their 10K is $48.3 billion, and their shareholders' equity is $72.9 billion, giving a debt to equity ratio of 0.6. Next up, we have our debt ratio, which is total liabilities divided by total assets. This tells you how much of your assets are financed by debt. If this exceeds 0.6, it signals heavy reliance on borrowing. So many investors prefer companies with moderate leverage. It shows financial discipline. With that said, Tesla had a debt ratio of 0.39, which shows moderate borrowing practice. Up next, we have our interest coverage ratio. In that, we take our EBIT, or earnings before interest and tax, divided by our interest expense. This shows how easily you can pay your interest from operating income. A ratio below 2 is a red flag. It means you're barely covering your debt costs. Tesla's EBIT, or earnings before interest and taxes, is $7.08 billion and $358 million in interest expense. Therefore, the interest coverage ratio was 20, more than enough to cover any sort of interest expense. Okay, so now you know how much risk you're carrying, but now let's talk about something even more painful. What if you're sitting on assets that aren't pulling their weight? Next up, we're looking at efficiency ratios, which means, are you using what you have efficiently? Efficiency ratios show how effectively you use assets to generate sales or manage inventory. This is where hidden performance issues often live. wasted resources, bloated stock, or slow collections. Our first ratio will be inventory turnover, and this formula is cost of goods sold divided by average inventory. So if your ratio is a 2, that means you sold your entire inventory twice in the period, which is great. The higher the number, the faster you're moving stock, which is great for cash flow. If you have a low turnover, you're tying up money in products that just sit there. Tesla is a car manufacturer, notorious for slow moving inventory, especially in this environment. Tesla's cost of goods sold in 2024 was $80.24 billion, and their average inventory was $13.21 billion, giving them an inventory turnover ratio of 6.07. Next up, we'll look at asset turnover. That formula is going to be net sales divided by average total assets. This measures how efficiently your company uses assets to generate revenue. For example, a retailer might have a high asset turnover, fast-moving goods, small margins. A utility company might have a low turnover, but high stability. So Tesla's net sales in 2024 were $97.69 billion, and their average total assets was $122.07 billion, given a ratio of 0.8. So now that we squeezed every dollar out of efficiency, let's talk about results. Because efficiency doesn't matter if the bottom line isn't growing. So profitability ratios, are we actually making money? And these are the numbers that make or break investor confidence. Our first one is going to be gross profit margin. In this formula, we have gross profit divided by revenue times 100 to give us a percentage. It shows how much of each dollar in sales you keep after direct costs. A higher margin means strong pricing power or cost control. Tesla's gross profit was $17.45 billion, and their revenue was $97.69 billion, giving a gross profit margin of 17.86%. Next up, we have operating profit margin. This formula is going to be operating income divided by revenue times 100. And this one digs a little bit deeper. It includes overheads and not just production. Investors love this one because it shows how efficiently the business runs in day to day. Tesla's operating income was $7.08 billion, and their revenue again was $97.69 billion, giving an operating profit margin of 7.24%. Next up, we have the net profit margin. This one for the formula is going to be net income divided by revenue times 100. And this is the final profitability test. It's what's left over after everything, taxes, interest, and other expenses. If your net margin is shrinking, it's a signal to review your pricing, cost, or debt load. Tesla had a net profit margin of 7.3%, and their net income was equivalent to $7.1 billion, and their revenue was $97.69 billion. Next up, we have return on assets, which that formula is going to be net income divided by assets, and this tells you how effectively your assets are generating profit. A higher ROA equals more efficient management. And Tesla pulled off $7.1 billion of net income, and it carried $3.2 billion in total assets, giving it a 2.21 return on assets, which means they are using their assets very effectively. Next up, we have return on equity, and this formula is going to be net income divided by shareholders' equity. This one is a favorite among investors. It shows how much profit you're making for every dollar of shareholders' money. So if we take $7.1 billion in net income for Tesla and divide it by $73.6 billion, we're going to come out to a 9.6%, which is average to a little bit below average for Tesla. So we've covered survival, risk, efficiency, and profit. But now comes the ratios the market cares and loves, the ones that move stock prices. These are going to be market value ratios. What's the market saying about you? Market value ratios link your financial performance to your stock price. They tell investors how the market perceives your company's worth and whether it's overvalued or undervalued. So our first ratio will be earnings per share, or EPS, and this is net income divided by the number of outstanding shares. This one tells you how much profit each share represents. Investors track EPS growth religiously. Tesla has $7.1 billion in net income and 3.21 billion outstanding shares, which in turn gave us an EPS of $2.21. Next up is our price to earnings ratio. This is market price per share divided by earnings per share. Higher PE might mean the market expects future growth. A low PE might signal undervaluation or declining confidence. When pulling 2024 numbers, Tesla's stock price was $403.84, and this means that Tesla carried a PE ratio of roughly $182 at the end of 2024. Next up is price to book ratio. This formula is going to be the market price per share divided by the book value per share. A PB under 1 can mean the market value is your company below its actual assets, a potential bargain, or maybe even a warning sign. So if we take Tesla's year-end $403 market price and divide it by the book value per share of $22.67, we come out with a $17.81 ratio. Next up, we have our dividend yield ratio, and this is annual dividend per share divided by market price per share times 100. Income investors love this one. It tells you how much cash return you'll get for every dollar invested in the stock. Unfortunately, Tesla doesn't have a dividend as they're considered a growth stock at this time, but this one might apply to something like GE or Verizon, for instance. So let's go ahead and recap the 5 ratio categories. We have liquidity, which means can we pay our bills? And then we have leverage, which is how risky is our debt? We also have efficiency. Are we using our resources wisely? And then we have the profitability ratios, which are showing, are we actually making money as a business? And then we also have market value ratios, and that's what does the market think that we're worth? Each one gives a different lens, but together they show the whole story. So if you ever looked at a company's financials and thought, I don't know what all this means, but now you do. If you found this useful, hit the like button and subscribe for more.